The market is sending us a warning sign today, February 21st, 2020, and I believe odds are pretty good that we will enter a high volatility environment for the short term. And in this presentation, I want to talk about why the market has been acting so weird. Why is price action so bipolar that we see weeks and months on end with suppressed volatility and then all of a sudden spikes in volatility with lots of gaps overnight. And I will do my best to use simple terms to do this because the matter is actually quite complicated. Okay, so we have these two different volatility regimes. One is characterized by this grind higher with very little intraday volatility, and the second is this salami crash kind of price action where we see lots of gaps overnight and then momentum to the downside with a lot of volatility intraday. And the reason that we have this bipolar price action is the hedging activity of market makers. And what they are hedging is the huge option positions they are forced to put on, because in recent years the volume in options trading has just exploded. And because there is leverage in the options market, the hedging activity of the market makers is now the single most important factor. That is why the market does not price in economic reality anymore, and why we have this distorted price action that is out there. And there are many reasons why the options activity has exploded. One of them is that we've had now interest rates pretty much at zero for 10 years. And this creates a problem for a lot of institutions that rely on yields. So what do these people do that can no longer buy government bonds and generate income? They go out and they sell options, and they collect that premium as an artificial yield. And what they do is they sell at-the-money calls and at-the-money puts. I will not go into the details. It's really not necessary that you understand what they really do. But understand that they are selling massive amounts of options that have strike prices that are close to where the current index, the current S&P 500 is trading. So then we have another reason why price action is so distorted. There is this Fed put. We know that central banks have our backs. So whenever the market comes down, Jay Powell and his crew, he goes back into the basement and prints a lot of dollars, and then the market recovers. This has led to excessive risk-taking. And these people who have these leveraged portfolios, they then buy disaster insurance. And what they do is they buy out of the money puts in case something goes horribly wrong. And they do that also in massive size. The problem is now that we have a lot of people that are selling options that are at the money, and we have a lot of people that are buying puts that are far out of the money, but there is no natural counterpart to these massive volumes out there. This means that the market maker is the counterpart of all those transactions, and we are talking about billions and billions and billions of dollars, and they need to hedge their risk. And depending where price is relative to the option positions that they have, that is now the most important factor in determining price action. So market makers are now long at the money puts and calls in huge size, and they are short out of the money puts also in massive quantity. And to explain what this means, I'm borrowing a chart from Charlie McElligott of Nomura, and we see two graphs on this chart that represent two different option expirations. And when the graph here is in the positive, that means this area here at these strike prices, below you can see the different prices for the S&P 500. These are the strike prices. The market makers are long gammas. That is where they are long calls and long puts in this green rectangle. And to hedge those positions, they need to buy dips and they need to sell rallies. And that is why volatility is suppressed when we are in this rectangle. Everything flip-flops if price drops below this line where their positioning goes from long gamma to short gamma, which is here, because then when we see a gap down, to hedge that position, they need to sell into weakness. But it is also reversely true. If then the market gaps up, they need to buy into that strength. And that is why we see these violent drops with violent rallies followed thereafter, because that happens when market makers are short gamma. And this chart here is a few weeks old, but it looks similar right now. The only difference is that this threshold here is around 33.50, 33.47-ish today. And today price went from green, from this long gamma environment, into this quadrant, into the short gamma environment. And that is why I believe we will see heightened volatility for the next few days, maybe next few weeks. And that is why I do not believe it is wise to short UVXY right now. I actually like to be long UVXY even overnight. And when we go back to our two volatility regimes, what does it mean? When we are in the green sector, that means we see these small gaps and snooze where there is no activity during the day because the market maker buys every dip and he sells every rip. Now in this red section, we have this gap and run activity where we see strong momentum. A gap in one direction forces the market maker to move in the same direction, and that is why these massive runs can happen there. And I believe that we see further downside the next few days. We have to see what happens over the weekend, but I will stay long UVXY over this weekend and see how we open on Monday. I believe odds are pretty good that we will see a gap down and then follow through on Monday lower. To illustrate the two different volatility regimes, I took my crayons out here and I charted the VIX. There's a daily chart for the VIX, and you can see how bipolar the market really is, and it is simply a reflection of the gamma positioning of options market makers. And the VIX goes lower when the market maker is long gamma, and it spikes higher. Volatility goes through the roof when we go through that threshold that we went through today. And that is why I believe odds are pretty good that we could see one of those spikes here. And who knows how high it can go. Obviously, it has to do with headline risk. The worse the headline is overnight, the bigger the gap, the more market makers have to sell. So it's going to be very interesting. It will not be boring next week, but these things are temporary because there is a huge demand for extra yield. So at some point, institutions will come in and they will sell at the money calls and at the money puts. When they start doing that, the market maker positioning flip-flops around, and then we go from one of these crazy times in these yellow ovals back into this low volatility grind higher where the market maker then becomes long gamma, and we see little intraday activity. But for now, I want to be long volatility. I want to be long UVXY, and if you want us to send you notifications whenever we go long or short volatility, you can find more info at quantyeti.com/UVXY. If you have any questions, hit me up on StockTwits. My handle is @OptionBob.